Good afternoon. This is Sean Golding from Golding & Golding here to discuss the basics of the United States Republic of Korea tax treaty. We get lots of questions about tax treaties, so we're going to be doing a series on the basics of tax treaties and generally basics for individuals and for people who are considered U.S. persons and what kind of benefit they receive or don't receive from the U.S. Korea tax treaty. This tax treaty was entered into, give or take, 50 years ago. Tax treaties in general will impact citizens and residents in that, depending on the way of the verbiage of the agreement or the treaty, certain income may be limited or exempt. Now, when you're reading over a tax treaty, any tax treaty, it all has to be taken in consideration of the saving clause, which is normally found in Article 1 or Article 4 of the treaty, which basically says when there is a saving clause, the saving clause reserves the right of either contracting party, either country, to the treaty to tax the people how they would otherwise tax them if the treaty wasn't in effect. And this oftentimes will come into play when it is a residence-based taxation situation, such as private pension, which is generally taxed based on the residence. The U.S. follows a worldwide income model and is not going to let a U.S. person residing overseas to avoid U.S. tax on pension. But we'll get to that in a minute. Now, with the saving clause, there's also exceptions to the saving clause. And if there is an exception, which is normally the paragraph right below the saving clause, that basically says, hey, even though both countries want to reserve the right to tax citizens and residents the way they ordinarily would, as if the treaty was not in place, if it's exempt from the saving clause, that means the treaty will stand on those issues and that you will look to the treaty in order to determine the tax implications and not general tax principles. Okay, so let's start with some of the basics, which is passive income, right? Most people, they have dividends, interest, royalties, capital gains, real estate income. Basics. Something like dividends is going to be taxable by both countries. But when there is dividends being generated from one country, which is being earned by a resident of the other country, then the source country is generally limited in the amount they can tax to 15%. The same concept holds true for interest, except it's limited to 12%. So what that generally means is that if a taxpayer is residing in one country and they're being taxed in that country on dividends or income being generated from a source of the other country, that other country is limited as to the amount that they can tax. At the end of the day, normally foreign tax credits will avoid any tax liability. Now, foreign tax credits are not always dollar for dollar, but for the most part, depending on the total amount of income and the total amount of foreign income, will eliminate, if not avoid, most double taxation issues. Well, let me take a step back. There won't be any double taxation. It's just the tax rate in one country may be higher than the tax rate in the other country, so that if you're paying 20% in one country, 15% in the other country, well, then you may have a 5% differential in that you have to pay that difference in tax. You're not paying double tax on the same income that you've already been taxed on. Another common type of income is real property income, and other treaties have much more detail regarding that, but for the most part, when it comes to the U.S. Korea tax treaty, it just basically says it could be taxed generally at the source state. Another super common issue dealing with tax treaties is going to be pensions, social securities, and income generated or pensions that are public, right? So you got public pension, you got private pension, you have social security. Social security is generally going to be exempt from tax in the resident country and only going to be taxed at the source country. Receiving social security from the U.S. and you're living in Korea, for example, then generally only social security tax is going to be the country of source, which would be the United States in that scenario. Private pensions get a little bit more complicated. For example, Social Security is exempt from the savings, whereas private pension is not. So when you're reading the treaty, you're a U.S. citizen, you're living in Korea, and it says, hey, only Korea can tax you on your private pension, and it turns out for whatever reason, Korea doesn't tax you on that pension. Yay, right? You're not taxed, but then you have to go to the saving clause. The saving clause says the U.S. and/or Korea reserves the right to tax you as they ordinarily would in the scenario, and so the U.S. says, hey, you're a U.S. citizen, pal, you're taxed on your worldwide income, we're still going to tax that pension. Then you go to the treaty to see whether or not private pensions are exempt from the saving clause. Unfortunately, they're not, which means at the end of the day, the U.S. person residing in Korea receiving pension from U.S. source is probably still going to be taxed by the U.S. government. Again, double taxation credits would apply if applicable. Generally, government, public pensions, income, things like that are only going to be sourced from the country that's paying. You're earning money from the U.S. government, then only the U.S. government's going to tax you. Different treaties handle that differently, and there could be much more detail involving where the person earning the money is residing at the time that they're receiving that, or receiving the money or the income from the source country. If they're not living in the source country that's generating the income, then they may not receive exempt in the other country. If you're out of compliance, at my firm, what we focus on is offshore disclosure. If you're out of compliance for reporting income, assets, accounts, investments from Korea and other countries on your U.S. tax return, there's various amnesty programs you can use to get into compliance. There's the voluntary disclosure program if you're willful or just can't certify under penalty of perjury that you're non-willful. There is also streamlined domestic offshore procedures for U.S. residents, streamlined foreign offshore procedures for foreign residents, reasonable cause and delinquency procedures. We have lots of free information available on our main websites and our sub-websites. You can always reach out, schedule a reduced fee initial consultation if you think it's appropriate. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.